Hi everyone, welcome once again with a very important topic and very interesting as well, that is the economic value added. Friends, why we are discussing economic value added? It is because all that matters to us is how an enterprise performance has to be measured, because we as investors were interested to know how well my money invested or how much my wealth is getting appreciated in an organization where I have put my money. Also, from managerial perspective, it is often important to know what is the performance of an enterprise in terms of its value maximization. So put it simply, that we know that we have come from a very narrow concept of objective of an organization or profit maximization to shareholders' wealth maximization. So all that matters to us is to maximize the wealth of a shareholder. Now, what can be a parameter for us to assess whether the wealth of the shareholder is maximized or appreciated or not? Now, if we talk about the financial statements, we want to know the performance of an enterprise. We refer to the profits that the enterprise has earned. Now friends, profits have got a lot of problems, and that's why we have come from the profit maximization concept to shareholders' wealth maximization concept. And if you rely on profit, then the results may be misleading. There could be appreciation in profit, or profit could be satisfactory, but in real terms, in terms of value maximization, the value might have distorted. Now I will prove you how. Now friends, if I say profit is an accounting measure. As you know that we understand profit as a difference between the revenues and the cost that the firm has incurred across an accounting period. Now, if you remember, I'll tell you in a very simple form that if this is my financial statement, say in a T form, now this is my debit side and this is my credit side. In the credit side, we have certain incomes that we recognize, okay, and from income we deduct expenses, right? We deduct expenses, and whatever we get here is my profit, the net profit, net operating profit, okay? So we get it here. Now friends, when we are deducting expenses, it includes all types of expenses, cash, non-cash, all types of expenses are deducted. Included in these expenses is an interest charge, okay? What the company or the enterprise is paying as interest obligation for any loan that the company has borrowed. Now friends, here lies the difference between the traditional profit measure and the economic value added. Now, economic value added argues that when the enterprise is using capital, you know that capital has got two parts. One is the equity capital, and the other one is the borrowed or the debt capital. So this capital has got some charge that the investors are expecting, right? So my profit, what is my profit? I should obtain profit, or I should obtain the profit after deducting all the charges on capital from the revenue. I repeat again, what I am saying is that when I have put money in the form of capital, and capital is of two types, owners or equity capital and borrowed or debt capital, each of this category of capital carries a charge, right? Now this is the charge that the providers of fund is charging from an enterprise. Now how can I say I have profit? I would say profit that I obtain here minus the charges on capital, okay, whatever profit I obtained here, from there if I minus all the charges on capital, what I get is the economic value added. There is a value addition, right? So it could be so that you have made a profit, but when you go for paying the charges to capital, suppose my profit here is 20 million, okay, and I'm happy and I'm very satisfactorily reporting to my users of financial information that 20 million is my profit. But when I say the charges on capital that the investors are charging from the company or the enterprise, it is 22. So you understand the value is not added, rather value is distorted. Okay, so economic value added means value will be added only when you have a surplus over the operating profit, okay, surplus of operating profit and the charges made on capital. So if there is a positive balance, then the value is created. If there is negative balance, means value is distorted. So being an investor or being a provider of fund, I should be careful not to consider profit as a true measure of performance. Rather, I should consider the economic value added, which is nothing but the profit minus charges on capital. Now you will see that I said that there is an interest payment that is included here. Then fine, I have included the charges of capital and I got the net profit. What's wrong in it? There is something wrong. What is wrong is you have taken interest on the borrowed capital, but you have not taken the interest or the returns that, not interest, the returns that the equity holders or equity fund providers are expecting, right? So our accounting measures do take care of interest, but it does not take into account the returns that the equity shareholders are expecting. What we do, we report 20 million as a profit, and then from the profit we distribute as dividends, corporate tax and retained earnings, right? So from this surplus I pay the equity dividend, we pay corporate tax, and we retain a part of profit or plow back the profit. But it's not a right practice, in the sense, if you consider value addition as your objective of assessment, then this is not the right way. You need to know what is the profit only after deducting the charges on capital, right? So this is the foundation for our discussion today. All that we understood is that economic value added is a wider concept. It's not an accounting concept. What it tries to find out is the value addition. Is there any value addition? Value will be added only when we have a surplus of profit and charges on capital. Okay, so charges on capital over the profit, if there is a profit positive balance, then the value is created. Simply profit does not carry any meaning for investors in true sense, right? Now this is the first episode. Let's move on to the second episode. Now let's understand the second part of our discussion. Then we will move on to the third part. So we know that what is the concept of economic value added. Now I would like to draw your attention to a financial statement in a very simple way, that I have my revenues here and I have my expenses, and inside the expenses I have one item, interest. Okay, so I have revenue here, I have expenses, all the expenses here, and I have interest expenses also. From revenue I minus these two, whatever is the balance, on that I pay tax. You know that this minus this will give me net profit before tax. Okay, now from net profit, when I receive this, when I get the balance between the revenues and the expenses, I get net profit before tax, and on the net profit before tax I charge taxes. Okay, at some rate, at the rate of n%. So I charge tax at the rate of n%. Now friends, try to understand this fact, that when we have revenue one side and we have deducted all the expenses, and then whatever remains on that I have paid tax, and then what remains is the profit after tax. We call it PAT, profit after tax. Now friends, try to understand one thing. Economic value added says that no need to, economic value added concept says that don't include interest as an expenses now. Okay, you find out what is the profit without charging interest, and from profit you then minus the interest obligation or charges on capital. I'm just saying COC means charges on capital, which would include both the interest as well as the expected dividends, right? So now you see one thing, if I have to exclude interest, the logic is very clear why I am excluding interest, because I will not show it as an expense now. Let's find out the profit, and from profit I will minus the interest charges and the dividends, right? Now friends, if I am not showing the interest as an expense here, then can you understand this fact that because I have charged interest, my tax is reduced? If there is no interest, my tax will increase. So I'm getting some tax benefit because of the interest. So this is called the tax benefit on interest. right? So we are getting we are deducting interest, and because of interest my profit is going low, and because the profit is going low I am giving less tax. The volume of tax reduces. So if I am not including interest, then I also have to reduce the tax advantage. I mean, I have to deduct the tax advantage. One way I am not including the interest, my profit will rise. Another way, I am not deducting the taxes, my profit will fall, right? So this is my second episode, keep in mind. So second episode says that since economic value added suggests that find out the net operating profit, we call it NOPAT, that is net operating profit, net operating profit after tax. Okay, net operating profit after tax, find out. What is NOPAT? Means an income which doesn't contain interest charges, which is excluding the interest charges and the tax benefit on interest. You have to find out NOPAT, and from NOPAT you minus the charges on capital. So now instead of calling profit, I will call it as NOPAT. From NOPAT I have to minus the charges of capital so that I can get the economic value added. This is my second episode. Don't worry, because I will be presenting before you one practical problem which will make it much clearer. Let's move on to the third and the very important part of our discussion, then how to calculate economic value added. Economic value added is equals to NOPAT, N-O-P-A-T, net operating profit after tax minus. Okay, from this, as I have already told you, from NOPAT you have to minus the charges on capital. So what are the charges on capital? You have to first find out what is my invested capital. Invested capital, I'll just rub this part. Invested capital minus weighted average cost of capital. Weighted average cost of capital. So the principle is same, that I have to find out the NOPAT. As you have just seen, NOPAT means we are not considering the interest charges, and we are also not considering the tax advantage on interest charges. From that profit I will minus the charges on capital. What is the charges on capital? How much capital I have in my business minus what is the cost of capital. Now you know that cost of capital will comprise of two parts, the dividend and the interest. So I will take the weighted average of these two and then multiply with the this is not minus, into, multiply with this, then I will find out the net operating profit after tax. Okay, so this is how we calculate economic value added. Now friends, we now have to know how to calculate invested capital. It will be given, but even then some adjustments. We have to know how to calculate the weighted average cost of capital, and the last thing, most important, how to calculate NOPAT. So we are now into three things. One is how to calculate NOPAT, then how to calculate the invested capital, though it is given, but even then we have to find out something, and then weighted average cost of capital. Three things we have to understand how to do. Okay, but before we proceed, let us first understand that when we say economic value added, EVA is not an accounting concept. Okay, EVA is not an accounting concept, rather it is an economic concept of value addition. Since it's not an accounting concept, so we have to do some adjustments. Okay, there is a long you can say long list of adjustments that you have to keep in mind, but for simplicity I will just bring forward few. For example, depreciation. You know, depreciation is a financial transaction, right? So depreciation, if what you are doing, depreciation you are charging on profit, means you are reducing profit, or you are charging some amount of money which reduces our profit. So EVA says that, and that means what? You are reducing your profit. It says that no, depreciation should not be should not be a charge on profit. If you have charged it, then you have to add back the depreciation. I repeat again, depreciation should not be considered as, depreciation should not be deducted from NOPAT. Okay, that means your profit should not reduce by the amount of depreciation, so it has to be added back if it is. Okay, so because you will, in the exam you will given profit after tax. So if profit after tax means you have already deducted the depreciation, so you need to add it back. So depreciation, economic value added says that depreciation should not be charged. So if it is charged, you have to add back to the profit. Rather, that it advocates another type of depreciation called economic depreciation. Okay, instead of accounting depreciation, there is another thing that is called economic depreciation that you can charge to profit, right? Next is non-cash transactions. Non-cash transactions should not be deducted from profit, rather it should be capitalized. Capitalized means it should be added to the capital. Okay, so that means it should not be deducted from profit, so we have to add it back with the profit, and it should be capitalized, means you have to add it with capital. Okay, next comes your research and development, and say research and development, and say staff training and development. This is also with the same logic that since you have spent money on research, development, staff training, these are some expenditure, the benefit will come to you in future course of time. It is a kind of one-time investment, so don't charge it to the profit, rather you capitalize it. So you have to add back with the profit, and then you have to add it with the capital because it has to be capitalized. Okay, so these are certain things, please keep in mind, although there are plenty of such. Similarly, advertisement expenditure also. Advertisement expenditure, when you are advertising, you are incurring some cost, but this cost is with the objective of gaining some returns in the future. So the same logic prevails, that you have to add it with the profit, you have to add back. Okay, add back means you have already deducted from the profit, no? So you have to add it back and you need to capitalize it. So friends, these are certain notes that you have to keep in mind. Now let's come back to how to calculate NOPAT, and then weighted average cost of capital, and some, as I said, invested capital. So capital should be adjusted for certain things. What are certain things? As you know that non-cash transaction has to be added with the capital. Research and training and development should be added with the capital. Advertisement expenses should be added with the capital. So that's why we have to say this as an adjusted capital. Sometimes we call it as adjusted capital, because you are adjusting for certain items or certain transactions or certain events that are actually taken care of in the accounting records in a different way, but economic value added requires us to give a separate treatment by capitalizing some of these items, right? Now coming to how to calculate NOPAT, and that's the last part of our discussion, how to calculate NOPAT. So friends, for calculation of NOPAT, we have got two approaches. See, you have got profit after tax, this you need, or else you need the operating profit. That means you can start NOPAT calculation either from PAT, that means profit after tax, or from operating profit. Let's see how. So first we will start from PAT, alternative 1. How to calculate NOPAT? Let's see the alternative 1. First we will write profit after tax. The profit after tax is 675. But as I have discussed, that economic value added says that we should not deduct interest now. We will deduct interest later. So we have to add back interest. So add interest. So when we are adding interest, we are writing 775. Let's suppose this is in rupees in crores. Okay, now see, we have added it, but don't you remember that I told you that whenever you are deducting interest here, you are saving some profit, and because of which you are paying less tax. So but now that you are added the interest, so you should not get the benefit of tax also. So we will write here less tax advantage on interest. Because I have charged interest, that's why my tax reduced. Now that I am not charging interest, so my tax burden should rise. So on additional how much? 25% of 100 rupees. So 25% of 100 is 25. Okay, so now that what you get is known as the net operating profit after tax. So that will be 750. So this is my NOPAT calculation under alternative 1. Let's see under alternative 2. As I told you, under alternative 2 we have to start from operating profit. So let's start. I'll just rub this and come again. So under alternative 2 we will consider first operating profit. So we will see operating profit is equals to rupees 1000 crores. So we'll write here 1000. Okay, from this we have to less the taxes because we are not charging interest. We don't need to. So less taxes. So it's very easy. 25% of 1000. So yes, 1000. So it comes to 250. And what we get here is 750, which is exactly same as we calculated under the first approach, net operating profit after tax. So friends, what is this 250? 225 which we already charged, and the additional 25 rupees because of this 100. So this 250 is nothing but 225 as we already charged plus 25 which we are charging now. Okay, so friends, this is how we calculate the NOPAT under the second alternative. But we should not stop here. What is our objective? Find out economic value added. And for economic value added, the first thing that we have to calculate is NOPAT. Right? So friends, for NOPAT calculation, you just have to keep in mind the interest charges and the tax advantage of interest that has to be adjusted. Apart from this, there are certain adjustments, as I told you just now, that cash, non-cash expenses, research and development expenses, training and development expenses, depreciation expenses, these are not to be charged against profit, and therefore it has to be added back. So if there is any non-cash transactions, it has to be added. Any research and development charges has to be added back. It depends on your question, depends on the situation. We will take up in the next video about the questions. Let's talk about the next part. Now we know what is NOPAT. So we should not forget our economic value added is equals to your NOPAT that we have already calculated minus the capital into the weighted average cost of capital. So we know NOPAT, we have calculated. Capital will be given to you and will be known, and capital needs to be adjusted, as just before I explained you that since some non-cash expenses are to be added back with the profit, it has to be capitalized, means it has to be added with capital. Now let's see what is weighted average cost of capital. The weighted average cost of capital is equal to, we have got two types. One is the cost for equity, we call it KE. Another is the cost of the borrowed fund, we call it KD. Okay, so we will know how to calculate the weighted average cost of capital. It is very simple. You just have to apply one formula. So friends, I have written the formula and let's see what it is. So KE is the cost of equity, say 10%. So you will write here 10% into KD is the cost of debt, say 8%. So I am writing here 8%. E means how much is my equity capital in the business, say 200 millions. And E plus D means 200 plus what is my debt capital, say 100. 1 minus T is the tax advantage that has to be taken care of, say 25% tax, into how much is my borrowed capital, 100, divided by what is my equity plus borrowed, 200 plus 100. This is how you calculate your weighted average cost of capital. So friends, there are simply 3 steps that you have to do under economic value added. First, calculate NOPAT, keeping in mind the interest and the tax benefit. Then you have to know what is capital. Remember, capital will be known, but you need to adjust for any capitalized items like research and development, training and development, etc. Then comes weighted average cost of capital. You just have to put this in the formula. You will get what is the weighted average cost of capital. Now friends, when you put it in the formula, you will get a value. If it is positive, means the performance says that the firm has provided or added value. There is economic value added, otherwise there is value distortion. So friends, at the end I would like to just tell you that this concept of EVA was propounded by Stern and Stewart and Company in 1989. Okay, so in 1989 this concept was propounded by Stern and Stewart and Company. Okay, so friends, we know how to calculate the economic value added. Of course, it is a true reflection of whether the firm is actually moving towards the value maximization of the shareholders or not. Friends, in the next video we'll pick up a problem which will help you understand how to do the sums on economic value added. See, this was a small example by which we could know how to do what are the steps and how this adjustments of capital is required. However, we have not taken up any such adjustments where capitalization of certain items are required. We will see them in the next video. Till then, goodbye.